Hello everyone and welcome to this webinar. My name is Lucy Moore and I'm a Professional Education Manager at ACCA. So our session today is the second in our series of 2 webinars to support your preparation for the Management Accounting or MA exam. And I'm really pleased to be joined by expert tutor Steve Willis. So Steve has a huge amount of experience as a specialist trainer in finance and accounting. And when I hand over to him in a second, he'll give you just a bit more information about his background. And in this webinar, Steve is going to be covering variance analysis in more detail. So it's something that he touched on in the first webinar, going into more depth this time round, as well as giving you some more great exam technique advice and study tips. Now, we should have some time at the end to take your questions. I'm also going to be working behind the scenes along with a colleague to answer as many questions as we can. But please note, we can't guarantee responding to everybody directly, either verbally or via web chat. But like I said, we'll have some time at the end, hopefully, that we can share some of the questions that you've been asking us that we feel will be really useful for everybody to hear. So if you'd like to ask a question, please click on the Q&A button and you can submit it there. That's all of the kind of housekeeping introductions done. So Steve, I'd like to hand over to you to kick off, please.
Great. Thank you, Lucy. Hello, everyone. Welcome back. If you were here a couple of weeks ago, if you are new, great to have you here. My name is Steve. I will be your host on this webinar. I'm delighted to be here with you. I've been helping people like you pass these difficult ACCA exams for about 20 years. I'm based here in Prague, Czech Republic. I work here for the PwC Academy, and I do courses that reach people around the world on a regular basis. You might have seen some of my articles on the ACCA website, as I like to write technical articles, and I also do process improvement work when I'm not teaching 4 different shared service centers in the region and in India. Now, guys, what are we going to talk about this time? Well, last time we met, we talked about some difficult topics. We talked about preparation for difficult topics. We talked about marginal and absorption costing. We got started with cost behavior, and then we started looking at variance analysis, which is one of the most difficult topics in the syllabus. It's also an important topic because it becomes assumed knowledge for your higher papers, and it also features in section B of the MA exam, right? So you could get a big question on this topic. So today, I'm going to take you through this difficult topic of variance analysis. And with this methodology, you can also then unravel some of the other difficult topics in the syllabus. Okay? I'd like to practice some questions together and talking about exam technique the whole time. And we'll take your questions at the end of the session as well. So, friends, let's jump in and just get started. Let's warm up with some of the topics that we looked at last time. And don't worry, if you missed our last session, check out the resources tab and you can get the link to the recording of our last webinar. Here are a couple of questions for you. So have a look. I'm looking at a theoretical type of question. It's not numerical, okay? So you're not going to just jump in and look for the correct answer. You're going to eliminate the obvious distractors and try and find the best answer. So we're looking at a question about marginal costing. Which statements are true? I'll give you 30 seconds, guys. Review these statements. Now, also look at the answers. One of them at least has to be false, right? So they can't all of them cannot be correct. Guys, you're checking this out? Trying this question at home? All right, let's look at it together, guys. Statement 1, contribution per unit will be constant if the sales volume increases. Guys, absolutely. A contribution per unit is price minus variable cost. There's no economy of scale there. It's the fixed cost per unit that drops, okay? That's where they got that from. No under or over absorption of overheads. Guys, that statement is true. We only have over-under absorption and absorption costing, as you know. So marginal costing does not provide useful information. That is totally false. I use marginal costing all the time when I am making business decisions. So what do we like? I like answer A. How did you guys do? Did you guys get answer A as well? I bet you did. Let's try another question together. Guys, we started talking about variance analysis last time, and we talked together about the different types of standard. So I will give you a moment. Check out this question together. You guys are checking out this question. You're reading those different answers. Only one of those statements can be correct. We're reviewing our topics from last time we met. We talked about types of standard. Guys, have another couple of moments there to give this a try at home. What do you think? Do you think it's A, B, C, D? What are you thinking? Well, let's have a look together, friends. Which of the following describes a basic standard? Well, do you like answer B? I don't like answer B. Okay, current standard is the standard that is based on our current prices and the current ability of the workforce. So B ain't correct, guys. How about C? Ideal standards. No, that would be the standard if we were a basketball team and we used Michael Jordan's statistics as the standard for all other team members. Well, guys, that's unachievable. That is not a basic standard. How about D? Do you like D? Efficient levels, but it allows for some normal waste. Nope, it ain't that, guys. That is called the attainable standard. So the answer, everybody, is A, unchanged over time. Basic standard might be helpful for statistical analysis if we're trying to understand the trend of a learning curve or something along those lines. But for controlling our workforce, motivation, the basic standard, not the best. Okay, friends, let's continue with our discussion of variance analysis. Let's just recap what we talked about last time. As you remember, variances are all around us. It is a standard tool in control in many businesses. If you go to a fast food restaurant on occasion, standards are used to control performance there, the size of the burgers, the time of the workforce, okay? So when we're talking about variance analysis, it's a traditional tool for control, invented in the mass production. And it's based on that concept of standard costing, right? Where we use a predetermined budgeted cost per unit, which will then drive my budgeting and my controlling mechanisms, processes. And whenever we're doing a variance type of question, we're going to need information about that standard cost card. And let's look at a standard. And again, the nature of the problem. If you remember last time when we met, I introduced you to my friend Wesley, who has a bicycle factory, and he's having a bad week, if you remember. He started a new line of business, electric scooters. He set a budgeted contribution for the month of $100, right? That's his budget. And his actual results, guys, 48. So he was off by 52, having a bad week. He's going to ask the question, why? Why was my contribution lower than expected? And friends, it's variance analysis, and what we will do next to help answer that question precisely. Okay? Now, we're going to be looking at standard cost cards again. You're going to be looking at them all day long when you're studying this chapter again. Now, standard cost cards, as you remember, this is essentially the budget per unit, the budgeted selling price, the budgeted costs per unit, and then the contribution or the profit. And very important today, I'm going to highlight this. We're going to need this information. When we're looking at the variable elements, the variable costs, there are always two components in the standard cost card, guys. The amount of something, so in direct materials, it's kilos. In labor, it's hours, right? The amount that goes in, and then the cost or the rate, right? So the amount per kilo, the amount per hour. You're going to need that information. And when you're doing questions, you're going to need to find the standard price, the standard rate, the standard kilos, standard usage. Now, we talked about the flexed budget last time we met. Just another quick look at that. It's super important when we're doing variances. If you remember, we said the original budget was 100, right? Sales minus the $50 is that 100 off of that cost card. Then we had an actual results of 48. And look at this, we sold fewer units. That's a bummer. And a common mistake when we're doing variance analysis is to try and control the business by comparing the original budget to the actual results. Friends, if we do that here, have a look at that green line. So my original budget was $50 for the variable costs. My actual budget variable costs are 48. Well, I might say, oh, that's good news. I saved $2. Look at that. So the production team and the purchasing team did awesome. They saved money. Friends, that is the classic mistake. Remember, we cannot compare results across multiple or different activity levels when we're looking at the variable elements. Imagine a restaurant. On Monday night, they have 10 customers. On Friday night, they've got 80 customers. Of course, the food costs, the variable cost, are higher on the Friday. They had more customers. So in order to make a meaningful comparison, we pop in the flexed budget. Flexed budget, if you remember, it takes the monetary values from the cost card, okay? Then we take the actual amounts, okay, from the results. And with a flexed budget, we can then answer the question, 8 units should cost and should earn of revenue and did. So friends, look at that. Using the flexed budget approach, we can now have a meaningful review process, and we can now say, oh, look at this. When we make 8 scooters, it should cost $40. It did cost 48, so it's an adverse, not a favorable variance. Guys, that's the flexed budget, a critical concept in financial control and in all of your management, accounting, and performance management exams. Okay, friends, let's now continue. I made a recording, And I'm going to take you through an example. You can find this example right now in the resources section. So if you have a big computer screen, you can pop open the PDF and you can follow along. However, if you don't, I've copy-pasted all of the information that we need into the video. And I also want to just recognize that there are many learning styles out there. So if you are a reflector, if you like to learn at your own pace, please watch the video, but don't be frustrated if you don't capture everything. You can come back and watch it again, okay? So with those notes, let's check out the next part of this story together. We're talking about the widget company, okay? Widget is a fictitious whatever that we use in accounting to talk about costs. So we have the widget company. And widget makes a single product, friends, and they use marginal costing, okay? That's an important clue. So you remember marginal costing, price minus variable cost is contribution per unit, okay? And we have a standard cost card for this company widget, guys. And we have a selling price of $80, okay? So that is the preset. That is the selling price that we expect to achieve in the coming period. Now, look at this. We've got 3 variable costs. We've got direct materials, direct labor, variable overheads, friends. And look at that. All of them are stated with 2 components, the amount of something and then that value of something, right? That rate. So we've got the 4 and the 3, the 2 and the 10, the 2 and the 2. Guys, marginal cost or variable cost, okay, is 36. So contribution per unit, guys. What's the contribution per unit? Do we know the selling price? Yes, we do. Do we know the variable cost or marginal cost? 36. Yes, we do. So we know the contribution per unit. Okay, guys, let's watch the video now, and I'm going to take you through the first steps of controlling performance with variance analysis. Here's the information that we need, and this is from the PDF document that you can find in the resources section at the bottom of your On24 screen. But if you have a small screen, don't worry, I will reproduce this information as and when we need it. Now, in order to calculate the sales variances and the total cost variances so we can control performance for this company widget, we need the standard cost card, which we just looked at right here. We need their original budgeted information, which is here, 1,000 units per month, and fixed overheads of 18,000 per month. And last thing we'll need is the actual results, and we will come to that momentarily. In order to save time, I will work in the spreadsheet that you see on the screen here. Now, if you have a big screen, you can now open up a spreadsheet and arrange your windows side by side so we can work together, or you can work on paper with me. And I've also given you the answer, the solution in the resources below. So please follow along, even if you don't write down every single figure. You can come back and try this on your own. Remember, in the MA exam, you will not need to work with a spreadsheet. The exam is 100% objective test. So this spreadsheet is just for demonstration. It's not for exam technique skills. However, in paper performance management and in your higher papers, you will be using spreadsheets, so why not get started now with a little practice? In order to control the performance of this company, we need the original budget, we need the actual results, and in between the two, we need the flexed budget. Okay? This is information from the budgeting section of your syllabus. The flexed budget can be tested in the context of variance analysis here, or it could be tested independently. Just prepare a flexed budget. Okay? Now, let's set our first row to the units for each column. Then we'll create a P&L. Top line of the P&L will be my sales, my revenue, from which I'll subtract my direct materials and my direct labor and my variable overheads. So subtracting my total variable costs from my total revenue will give me a contribution line. From contribution, we will subtract the fixed overheads and arrive at the profit for the period. Take a moment to catch up and write all of that down. Let's continue with the units, and the budgeted units are 1,000. Okay, and we will round off to the nearest thousand, and we will work in some countries' dollars. So, the revenue, okay? If we sell 1,000 units multiplied by an $80 selling price, divided by 1,000, because we're rounding off, we're at 80. Okay, so we can just pull those figures from the cost card and get the original budget. So, direct materials will be $12,000. Direct labor will be $20,000. Variable overheads will be $4,000. Contribution, as we calculated earlier, 44 per unit, or we can just double check that with the sum function here, and it will be 44 minus those budgeted overheads of 18, and we are at a profit of $26,000. Let's now plug in the actual results. First thing to notice is that we sold fewer units than planned. Units being lower means the sales volume variance will be adverse. And we see that the actual revenue was 74.9. The actual spend on materials was 11.1 thousand. Actual spend on labor, 18,200. Actual spend on variable overheads, 3.3. Actual contribution, $42.3 minus the actual fixed costs. Wow, 4,500 more than expected. Negative 22.5, and that is equal then to the sum of those two figures, a 19.8. So we see the budgeted profit, 26. Actual profit, 19.8. We want to understand what went wrong so we can take corrective action and fix the situation for next month. In order to do that, we need to create the flexed budget. If you remember, the flexed budget, it takes the units from the actual results and the costs from the standard cost card. Remember that the flexed budget answers the question should, actual results did. So when we sell 950 units, we should earn $80 per unit divided by 1,000, rounding it off. We should have 76,000 in revenue. We did get 74. Bad news. When we produce and sell 950 units, one unit should cost $12. We divide that by 1,000, again, because we are rounding off. And can quickly do that. Equals 950 multiplied by -20 divided by 1,000. Yes, friends, I know I could be using formulas and functions and absolute cell references, but I'm not. That is equal to 950 multiplied by a -4 divided by 1,000. There we go. Let's copy that contribution formula over there. Now, what do you think? Fixed overheads. When we produce and sell 950 units, should fixed overheads change? Should they drop? No, it's a fixed cost. It's not related to activity level. So I can copy paste that over there. And same thing with the profit formula. Copy, paste. Now we've produced a lovely statement comparing our original budget to our flexed budget and then with actual results. And we can make a high-level controlling report. Let's start with the sales volume variance. All right, and the sales volume variance, as you remember, is the difference between the budgeted profit and the flexed profit. And because we sold fewer units than planned, it's adverse. So I can now just use the spreadsheet to help me do that. That will be equal to my flexed profit minus my actual profit. Okay? And that is adverse. 2,200 adverse. So sales manager needs to explain why was the demand for our products lower than expected. This is interesting when we're using marginal costing. Okay, the sales volume variance can be taken also off of the contribution line, right? Because fixed costs are the same. So it's the 220 will be the same whether we use the profit line or the contribution line there. Now, the other variances will be a comparison between flexed and actual. So we can do the figures in column G and then the label in column H. When we sell 950 widgets, we should earn revenue of 76,000. We did earn revenue, 74.9. Okay, so that's a 1.1 thousand adverse. So now the sales manager really has some explaining to do. We sold fewer units at a lower price. So maybe there was a problem with the quality of our product. Maybe it's at the end of its life cycle. Whatever the reason is, we should investigate and take some corrective action. So that's the sales price variance, and it's adverse, A for adverse. And now we can just copy that formula down here. When we produce and sell 950 units, my materials should cost 11.4. They did cost 11.1. That is the total materials variance, and it is favorable. So the production team and the procurement team are making up for the poor performance of sales. Copy, paste, paste. Look at that. All of the variable cost variances are favorable. So good job, production and procurement. That's the total labor variance, and that is favorable. This is the total variable overheads variance. That is also favorable. Last but not least, we have a fixed overhead variance, which is the biggest number in our table, which is the biggest variance so far. That would be the total fixed overhead variance. That is adverse. I'll put the A down there so it fits. So, friends, now we can really control this business. And first thing we can say, profit is lower than budgeted because of problems with sales. We sold fewer units, and we sold those units at a lower price than expected. However, we had some recovery in our variable costs. Let's go talk to production. What did they do to make those savings? And then we see the biggest figure here, an adverse total fixed overheads variance. So maybe we need to go talk to the facilities manager. Maybe that's the manager in charge of that. And what do we find out? Oh, it was a really cold winter, and we paid more for heating oil. Not to mention the price of heating oil might have gone up, maybe. Or maybe we hired more fixed salary supervisors. Whatever the reason, we can investigate and find out. Hello, friends. I am back. Everyone breathe. I'm breathing as well. Okay, a lot in there. If it went too fast for you, remember, you can always watch the video again. I thought it was important just to go through that because that is fundamental to what we do with the rest of variance analysis. It comes up in budgeting, it comes up in performance management, it can come up in section B of your MA exam. So please really understand the importance of that flexed budget as a tool for control. And to summarize what we just looked at, we had an original budget, we had actual results lower, and first thing we always do is we compare the bottom line of the budget to the flexed. Okay, that's the only time we ever go to the original budget. And we call that a sales volume variance. Friends, a common mistake, and this would be one of the distractors, one of the wrong answers in your MA exam, would be comparing the revenue line. Sales volume variance, it's looking at the net effect of lower units, right? We earned less revenue, but we had less variable cost. So it's the bottom line. It's never the top. Okay, guys? Now, once that is out of the way, we move on to the sales budget. Okay, sorry, we move to the sales price variance. We look at the flexed versus the actual. And we see again, that's adverse. And then we can look at variable costs from flexed to actual. And we see the total variable cost variance is favorable. Friends, a couple of questions came up during the viewing of the video. Why are some things negative? Well, guys, if it's negative in my P&L, that's going to be a cost, guys. If it's a positive number, that's going to be a revenue line. Let me pop open the other. Why did the fixed costs change? We don't know why the fixed costs changed. That's our job as a controller. We see that they went up we have to investigate, okay? Fixed costs can go up, okay? Fixed overheads, indirect, okay? Heating, lighting, salaries. So that can happen in real life, right? All the time. The fixed costs are never going to be precisely as budgeted for a large organization. Guys, let us try a couple of questions and then move to the next complication. Guys, look at this. This is just like we did before. Guys, this is a question giving us a budget, a flexed budget, and actual. I've got 3 questions for you, and I'd like you to answer me in the group chat. You guys can find the group chat. Well, type in your answer for me. Unfortunately, the group chat only holds 500 of you, so if you move quickly, you can get your answer in there. Friends, find for me the sales volume variance, the sales price variance, and the total printing cost variance, okay? Now, printing cost there is a variable cost. That's a hint, okay? It is a variable cost, okay? You guys have 30 seconds to do that. The clock is running. You're going to put your answers into the group chat. Wow. Donan is on fire. Right on. Virtual high five right at you, okay? Quick work. We've got some very brilliant people on the webinar today. Good work. Kind of a spoiler there, Donan, but c'est la vie. You got it. Prakash, perfect, perfect. If you were on my training course, I would throw you a piece of candy now. That is what would happen. You would catch a little chocolate. Okay, friends, remember, sales volume variance is always the bottom line, right, between budget and flexed. Right on, Sruthi, right on, Malhar. You guys all got it right, right? So look at that. We were expecting 120. We got -10 in flexed. Guys, that's a 130 adverse. Sales price variance, we pick up right there. Top line, right, from flexed to actual. And the variable printing cost variance, right? So that's 300 to 280. That's an adverse of 20, everybody. The big mistake, guys, the big mistake there would be to go to the 360, when the only time we ever go back to the original budget is at the sales volume variance. That's the only thing that looks at units. Okay, team? Let's move on. One more question here. Then we're going to keep moving. Which of the following statements best describes the volume variance? Whoever can pop that into the group chat window gets a virtual candy, okay? You guys, flexed to actual, nope. When we're talking about flexed budget to actual, both of those budgets have the same number of units, okay? The flexed budget to the actual will not tell us if performance is good or bad from a difference of units. That's right, it's the difference between the fixed and the flexed, or the flexible in this case, okay? Super work, you guys. Let's move on. Now, we have a new problem to deal with, okay? Are you ready to view the next video? Again, if you don't capture every word, if it's going a little too fast for you, don't panic. Just try to get what you can, and then you can go back to it at your own speed. Let's visit with my friend Wesley. you met Wesley on our last webinar. Wesley is my friend who owns a bicycle manufacturing company. Wesley is having a bad month again. Wesley is looking at his costs. He is looking at the costs of his direct materials. And he had a flexed budget, $180. Now, I'll tell you, the units, the actual units were 18 bicycles, so we can reverse engineer the standard cost for direct materials for one bicycle, which would be $10. So when we produce 18 bicycles, direct materials should cost $180. I'll show you why he's upset, because his actual results are $215. So we have a total direct materials variance adverse of $35. Now, Wesley wants to know what's going on, so he calls his production manager. Let's name him Pete. Pete's not a happy camper either. Now, before Wesley can say anything to Pete, he's called him into his office. Pete says, "Hold up. I know what you're about to tell me, and it's not my fault." And he goes on to blame the procurement manager or the purchasing manager. The production manager goes on to say, well, the procurement manager bought very low quality aluminum tubing for our bicycles this month. And because of that, we had to waste a lot of material. Many of the bicycles did not pass quality control. So we wasted more material than normal. Now, Wesley is confused because he just finished speaking with the purchasing manager, and the purchasing manager received the gold star, right, for being employee of the month, for saving money. Now we have a conflict in performance management, friends. The total variance that we spoke about several minutes ago, okay, is great for high-level control. Okay, this adverse 35 variance that we see here is nice. But in order to properly control the business, we need to assign controllable KPIs to our management, to our staff, and there are two people who deliver that total materials variance. And that's the case with all of the variable cost variances. So now we're moving into the tricky task of breaking the total variance into two components. Let me show you how I do that, okay, with a wonderful pro forma or template. Friends, we will use the figures from our widget example to do the variable cost variances. And you can use this approach for your further question practicing. Every ACCA book that I teach from does the variances slightly differently. Okay, so remember that there are multiple approaches to this topic. All of them are valid. You'll get full marks and you'll arrive at the same figure regardless of the method you use. I'm showing you what I think is the easiest way to do it. Okay, and let's start with direct materials, right? So we're doing the widget direct material variance breakdown. Let me show you what I do. Well, I will use alphabetical order to help me memorize this, right? There are many variance formulas. I can remember when I was a student, I had a lot of trouble trying to memorize 15 or so discrete independent formulae. It was easier for me to use a system as I'm showing you now. So if you can remember these letters, A, 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 S, S, S. Everybody say it at home. AA, AS, SS. If you can remember these letters, it's going to get you out of trouble in MA, and you can use the same system when you do the advanced variances in performance management. So I hope you take this approach on board. Now, the letter A stands for actual. The letter S stands for standard. The first variable in the pair of letters is always going to be the amount of something. And then the second one will always be the monetary rate of one of those things. And it's always going to be this. Okay. Amount, monetary value. And when we're talking about direct materials, it's going to be the actual quantity, actual price, right? So you just plug those in. Actual quantity, standard price. Standard quantity, standard price. AA, AS, SS. AA is always going to be the actual spend. How much did we spend? SS is always then the flexed. So we're still going from flexed to actual. How much should we spend when we produce 950 widgets? Okay, now we can look right in the actual results. We can see that the actual quantity is 3648, 3,648 kilos. You can plug that number in. Now, they don't give us the actual price directly, but they do give us the total spend on the materials, which is rounded off to 11.1. So that's the actual spend. And using a little bit of division there and algebra, we can work backwards and get that the actual price was $3.05, right? 3648 multiplied by X will be the 11,000 and change. Now, standard price, we go to that cost card and we take out the $3. That's how much we should spend. So that always goes here. There's my standard price. Last but not least, we need the standard quantity. And this causes a lot of confusion. Standard quantity is the flexed. It's the standard quantity of actual production. So we're always talking about 950. So 950 units multiplied by $4 per unit, right? So one widget should use 4 kilos, so 950 widgets should use 3,800 kilos. That is the standard quantity of actual production. If we finish our multiplication, that comes to 10.9. That's the 3648 times 3. And the flexed here, that will be 11.4 thousand. Remember, we're working in thousands again, rounding off, just to make this demonstration easier to understand. Of course, in your MA exam, you would follow the rounding instructions in each question. In each question, they tell you what precision to work to. Now, you know AA, AS, SS. If you can remember that our friend Pete, the production manager, is always over here, Pete is in charge of usage. Okay, purchasing manager is then in charge of price. And if you don't remember that Pete stands there, that you can just check out which variable is changing between each pair. Right here, it's the quantity. Quantity is about usage. Here is the price. Right? Price is about difference in price. We always move from flexed towards the actual. So the flexed budget to the actual spend. So if I'm using my letters here, I'm going from right to left. Okay, it's still flexed to actual. So we can put a little arrow here. And now all we have to do is this. When we produce 950 widgets, we should use 11.4 thousand worth of material. We used 10.9 worth of material. So look at that. That's good news. We used less than expected. So right away we see that we have a favorable variance. And if we compare the 11.4 SS to the 10.9 AS, we see that that usage variance is 0.5 favorable. Now, moving to the next part of this, when we go to the supplier and we buy 3,648 kilos, it should cost 10.9 thousand. It did cost 11.1. Right away, we can see that we spent more. That's adverse, and the difference is 0.2. So the direct materials price variance is 0.2 adverse. So maybe in this situation, purchasing manager bought higher quality materials, so the production manager had less wastage, giving that favorable usage variance. And the 0.2 adverse plus the 0. Favorable nets to the 0.3 total favorable variance that we saw in the previous activity. Let's try that again, friends, with the direct labor variance. Now that I've shown you the system, you guys can do more of this on your own. So, friends, we're now doing the labor variance. It still works with the letters AA, but this time it's going to be actual hours, actual rate of pay, actual hours, standard rate of pay, standard hours, standard rate. Production manager is still always on the right. This time, the production manager controls the time per unit. Do his workers go faster or slower than expected? That is then covered by the efficiency variance. And the other guy this time, maybe it's the HR manager, that would be the rate variance. Okay? Now, I'm showing you the information from the actual results and the cost card. Can you find the actual hours? I think you can. Can you find the standard rate? I think you can. I'll give you a hint. We're always talking about 950 units here. So I'll give you 1 minute. See if you can do this on your own. The clock is ticking. You've got to find the actual spend. Remember, AA is actual spend. The question is not asking for the actual rate, so we don't need to calculate it. We're just trying to get the end result, the variances. The clock is ticking, friends. You're trying this on your own, plugging those numbers in. Then you're going to move from right to left, just as we did before. Another couple of moments, guys. See if you can get this. All right, let's work together. So, looking right here, we see that the actual hours worked, 1824, 1824. They don't tell us the actual rate, but they tell us the actual spend on our workforce was 18,240, the 18.2. So we can then reverse engineer that figure right here, right? That's going to be $10 per hour. The standard rate of pay also happens to be 10. So look at that. The AS figure is 18.2. Again, now if we look at the cost card, we've already found the standard rate, $10 per hour. Each unit should take 2. Okay, so the last one is the 19,000. And we had that from our flexed budget earlier. And moving this way, we should use 19,000 worth of labor when we do 950 widgets. We actually used 18.2, right? So we had a savings. So our workforce was more efficient than expected. They went faster. The time, they did more units per hour. Time per unit was higher. And that difference is a 0.8, favorable. And look at this. When we buy 18.2 thousand labor hours on the job, on the market, on the labor market, we should spend 18.2. We did spend 18.2. That tells us that the rate variance was nil. We paid the expected hourly rate of $10. Guys, there you go. That is a system that gets you through all of the cost variances. AA, AS, SS. I suggest you practice this again, and then you can use this approach in your question practice. Hello, friends. I am back. What did you just learn? Say it at home. AA, AS, SS. And guys, that reinforces something that I was thinking about watching the video. It's very easy to get lost in the really big technical textbooks when you are studying for your MA exam. But I'd like you to always be stepping back and be looking at questions as you're studying, because the purpose of this, right, is to pass the exam and to be able to do the difficult questions. So when you're studying, be thinking about how you can answer the questions with any kind of a template or a system like I just showed you. There you guys are, AA, AS, SS. Now that we've done the breakdown of the variances using that approach, we can prepare an operating statement. And this will let us control the business with more precision. So let me show you what that would look like. Well, we know our core problem. Original budgeted profit is 26. Actual profit 19.8. Why is it lower? We need to control the business so we can take corrective action, process improvement. And we start there, we go there, and first stopping point is the flexed budget, guys, okay? Now, we would then start plugging in the broken down variances. So in between the operating, the original budget, and the flexed profit, we have the volume variance, okay? And you could even find that as a balancing figure if you needed to. And then we have the sales price variance, guys, right? So look at that. Our sales variances gets plugged in. Then our cost variances get plugged in. And those cost variances tell us why the flexed profit was different from the actual profit. And we can break down each, okay? Look at that. We had the adverse direct materials price, the favorable materials usage. So with that information, we can evaluate the performance of the purchasing department and the production department. Then we can look at the labor variance. And we see here, once again, efficiency is favorable. So the workforce went faster. Wow, production manager doing a great job, okay, of saving money. Then we can do the same thing with the variable overhead, expenditure, and efficiency. Guys, I didn't show you that in the video, okay? But it works the same way. You'll see that when you study this more, okay? You can just use the same exact system. And we see the expenditure variance. We didn't have a chance to do that one, was 4.5 higher on fixed overheads. Okay, so guys, there we have an operating statement. Okay, that is the purpose of all of this variance analysis work. Guys, let's try a couple of questions now. Let us try some questions. And I'm going to ask you to put your answers in the group chat. Move quickly. Only 500 of you at a time can speak in the group chat. So have a look at this one, team. A company has higher than expected staff turnover, and as a result, the staff are less experienced than expected. Guys, you got 30 seconds. If you get the right answer or whatever answer you get, put it in the group chat. Once again, Darwin gets the virtual candy. Camila, Daniel, you guys are great. Gosha, Arina, good work. Okay, you guys get C. Well, tell me this. If we have less experienced staff, are we going to pay them more or less? Well, less experienced staff are junior employees. Junior employees, right, without any other information, they'd be paid less than our experienced employees. Now, are new employees going to waste more or less than expected? Well, if you're new, imagine you're a new carpenter for the first month in a furniture factory. There's going to be a lot of waste as you figure out how to make chairs and tables. Oops, I cut this one wrong. Oops, I cut this one wrong. So, guys, I'm liking C as well. Good work. Let's try another one, guys. Now, the wording of these can sometimes be a little confusing. So let's read it together. A company has calculated a $10,000 adverse direct material variance. Guys, if they don't say price or usage, that means total variance, right? That's the total. By subtracting its flexed budget direct material from its actual results, okay? So did they do it correctly? First of all, someone tell me in the chat window if that's the correct thing to do. To get the total materials, we compare flexed and actual. Is that the right thing to do? It is the right thing to do, okay? So there's no trick there. There's no trick there. Now, see if you can answer that question, guys. There are 4 statements. Remember the exam technique. You got to look at those, look at the answers, and only 2 can be correct. So sometimes it's easier to eliminate wrong answers than find correct statements, right? Sometimes the wrong, the incorrect, the distractor is just jumping out at you. So cross that one out. That's right, okay? Nothing about units. The only variance that tells us about units being different begins with a V, and that is the volume variance, right? The sales volume. So nothing about units. Therefore, by elimination, the prices were higher or the usage was higher. So there we go. You guys who said C, you are all rock stars. Good work. Guys, here is now a tricky numerical one. Get out some scratch paper, get out a pen, and let's do this one, or you guys are going to do this one. Labor efficiency variance. Something like this can come up right in your exam. You press next, and you get a challenging numerical question, okay? First thing you want to do is just read the requirement. What is the labor efficiency variance? Now, don't start reading the bit above. You'll get lost there in the fog. Just labor efficiency variance. Those words trigger the deployment of the template. So you see variance, you write down the letters. AA, AS, SS. And then you remember, where does the production manager stand? On the right or the left? Oh, he stands on the right, doesn't he? And he's in charge of efficiency. Guys, I'll give you 2 minutes. See if you can get this. See if you can get this, okay? You gotta find, we're looking for efficiency only. We're only looking for efficiency. The clock is ticking, friends. You're doing it. Whoever gets it first gets a virtual ice cream cone. Let's see. Let us see, Komlan. Let's see if that's it. Let's let everyone get caught up. So if we're only looking for efficiency, remember we only need AS and SS, which is the nice thing about these letters. You lay out the template, you get organized, and that becomes a shopping list. Then you can read and you can pick out the variables and you know what you're looking for. You guys got another 30 seconds. I'm looking for efficiency only. Okay, friends, let's start plugging in some numbers together. Well, the actual hours, 378. You guys see that 378 right there? 710 units were produced in the period and the staff worked 378 hours. That 4725, guys, that's the actual spend, right? That's the AA, but we don't need it here, so I'm just going to ignore it, okay? Now, we produced 710 units. 710 times 0.5, okay, that would be the standard hours times the same standard rate. So now you break out your calculators and you can get both figures. And we always go from right to left, don't we? Right to left. And I can see that the number is bigger, isn't it? So when we produce 710 somethings, we should use 4.2 thousand. We did use 4.5. So the workers went slower, right? They made fewer units than expected. So it's adverse. And right away, if it was multiple choice, right, you could eliminate the two favorable ones and throw down a guess if this was the last one and time was running out, okay? 276 adverse. Remember, we're always going from right to left. Should, did. Should cost, did cost. It should cost 42.60. It did cost 45.36. Guys, it's higher. Right to left. Flexed budget, moving to actual results. Friends, that's just a little practice there. You have dozens of these questions in your question practice books. So now you know how to do those, okay? Now, guys, in this 1.5 hour webinar, there's no way I can show you everything. I have a YouTube channel, and if you follow that link, the link is also in the resources section. I've got 5 more videos there, and I also have a video where I show you 7 more templates. I show you the templates for over-under absorption, marginal costing, absorption costing, profit reconciliation, overheads, process costing, EOQ. So go look around in there. And if you have any more questions about this, just plug a question into the comments part there, because I look every morning, I look at those comments and I answer the questions, okay? So you can reach me there quite quickly in the comments section. Guys, your next steps. Last time we met, we talked about the importance of making a study plan. You can't do this in a couple of weekends, okay? Passing these ACCA exams requires commitment and planning and good time management. So make a study plan. I hope you've done that. I hope you're sticking to it. And the difficult topics like process costing, like variance analysis, like marginal and absorption profit reconciliation. Some people also get stuck on discounted cash flows, okay? Put those early in your study plans, because you need multiple sessions for the difficult topics. Okay, yep, make sure you're starting those early. Now, remember, Section B, excuse me, not Section C. The second part of your exam, you have multitask questions. These only cover budgeting, standard costing, and performance measurement. So you have to do a really good job on those 3 topics. And those are big topics as well, okay? So definitely budget time for those. Okay, now we mentioned the importance of getting an updated revision kit because some of the theoretical topics in the syllabus have changed, and if you want up-to-date questions, you get those from an up-to-date book. Okay, now, you must do the online specimen exam and extra objective test questions. As the exam is approaching, 2 weeks, 3 weeks before the exam, try the online specimen exam. That's be a very nice benchmark of where you are and what topics you're going to need to work on, okay? And this is a super cool resource. There are 3 extra practice tests available on the ACCA website. I use these in my course. I make my guys do those here at the PwC Academy. They must do those exams. And the cool thing about those exams, they're written by the real exam writing team. That's the real deal, okay? You know that those questions have been written by the same people that wrote the questions you'll have. They've been quality control tested, and it's the real feel of the exam, okay? A wonderful resource there, okay? Make sure you download and you do what the MA Essentials document tells you to do. That's a 1-page summary of exam technique, what to study, what important articles you should read, okay? Print that out, put it on your refrigerator next to your study plan, guys. Keep a positive attitude. It's very easy to get frustrated when you're studying for an ACCA exam. I can tell you firsthand, when I did the exams, I got stuck at financial reporting. I had to resit that multiple times, but stay positive. If you are confused or frustrated about a topic, stop, get a cup of coffee, go look at something else, try a new topic. Over time, you'll find that you're always going to be a little bit frustrated. Something's always a little bit fuzzy about MA when you're studying. But if you look back, what you were stuck on a couple of days ago, I kind of get that now. And that thing that you were stuck on a week ago, I get that now. Yeah, I understand overabsorption. Boy, I was confused about that a week ago, but it's sunk in now. So that's just part of learning difficult material, okay? So just stay positive. If you're frustrated, it's a normal part of learning. Guys, we've got about 15 minutes left. Any questions that you have about MA topics, about the exam, I am here to answer them.
Hey, Steve, can I just check you can hear me okay?
I hear you well, yes.
Perfect. Okay, so we had a few questions filtering through whilst your videos were playing, and you've addressed them. Just picking up on what you were sharing there on the previous slide around, final tips from you, what students should be doing as their next steps. We've had a question in from a student saying they do find those multitask questions difficult. Is there anything you could kind of advise around technique for those sorts of questions? So less thinking about the syllabus areas that those will cover, but more about, are there any tips you have for approaching those questions?
Well, you have to remember, guys, these multitask questions, okay? So these are 5 questions built on one set of information. And the reason that they're more difficult is because you have to process more information. It's 10 marks, right? There's 10 marks there. 5 questions for two marks. So first thing I'd like to say is that each of those questions, they will 100% be independent of the others, right? They're not building on each other. So what you need to do when you get to the first multitask, scroll through those 5 questions quickly. And if one of them is really difficult, come back to it and you take a guess, okay? And the second thing, guys, is question practice. There's nothing better than practicing. And the authorized, the approved learning providers have sections full of the objective of the multitask questions, okay? So you've just got to practice those, and you can take them in any order, okay? Don't try to go through sequentially. Just scan them, easy ones first.
Okay, perfect, Steve. Sorry if you just covered this, but we had another question which I think is also referring to these multitask questions. They're asking how many questions, I assume they mean how many questions will there be around any one scenario?
You get 3 scenarios and you get 5 questions on each.
Okay, great, thank you.
So that's 15 questions there.
Perfect. Another question we've had through, this is a slightly different one, a bit more of a technical question. This student is asking, how do they know which interest formula to use on the capital budgeting questions?
I think you're talking about if it's compounding interest or normal interest. Well, the details that you need will be there in the little scenario, and it's all about time value of money. Okay, so we're compounding when we're doing NPV, when we're doing IRR, when the investment stays in the bank essentially and continues to accrue interest. So the interest is compounding. That's how you tell. That just Go back to that chapter and check that out. You'll see that. And when you look in the revision kits, it's mostly going to be the compounding interest, guys.
Okay, perfect. Thank you.
Yes.
I've had a question which I think I would answer this question in a particular way, but I just want to double check with you to make sure that I'm not getting anything wrong. So apparently this student has been informed by their learning provider, their tutor, that if they're sitting the exam in mid-September this year, the syllabus changes which kick in as of the 1st of September won't apply for them, which I don't think is right. I think that if you are sitting your MA exam from the 1st of September onwards, you will be sitting it under the new syllabus. Can you confirm that's your understanding, Steve?
That is what I understand. There's a cutoff point, and that cutoff point is stated clearly in the new syllabus. And at that point, the new questions come in, the old questions get retired.
Yeah, agreed. Okay,
yeah.
So for the student that's asked that, if you're sitting in mid-September, you do need to be mindful of the syllabus changes. Steve covered them in his first webinar, and you can access the link for that webinar in the resources section of this session. Okay, so have a look at that.
And guys, there's nothing there to be afraid of. It's theoretical topics about technology, about big data, interesting topics. You can clear it in one evening of studying, okay?
Perfect. Thanks, Steve. I want to just ask another quick, we had another follow-up question on the MTQs, the multitask questions, where a student is asking for clarification that is part B of the exam, which I think is correct.
Yes, that's section B of the exam, section B.
And they're asking whether variance analysis would be covered in that section or just in...
Yes, it is. Absolutely, it is. That is why we talked about it. Variance analysis is a part of standard costing, guys.
Excellent.
And investment appraisal is also there. Budgeting is there, but remember the investment appraisal, time value of money, discounting, NPV, IRR, that's in there as well. So don't forget to study that.
Brilliant. Thanks, Steve. Another question here, another more technical question. This student is asking, what's the difference between cost of capital and return on capital?
Guys, the term cost of capital, that is a word that describes essentially the opportunity cost of the investors in a business. It describes the risk of the business. So if a cost of capital of a business, let's say, is 10%, that means that the investors in that business, the equity investors, the shareholders, right, and then the bank, the debt investors, their combined required return is 10%. Okay, that represents what they need, their hurdle rate. And the other term again, Lucy, was what? That's cost of capital, guys. Return on capital?
It was, cost of capital and return on capital.
Well, return on capital employed is what I know. Return on capital employed, that is then a performance metric. That is a measure that helps us judge performance. We have return on capital employed. We also have return on equity. If we're talking about return on capital employed, we're looking at profit from operations, okay? How much profit did a company generate? They sold their goods, they paid production and non-production costs. Now, we look at that against all of the money thrown at the business, the debt investors and the equity investors, right? So return on capital employed is a relative metric. What percentage is that profit from that capital employed? Now, return on equity then, we're only looking at the shareholders, and that's all the way down the P&L, right? The bottom line, that's the profit after tax. That's after all of the distributions to other people. The bank takes their interest, the tax man takes tax. what's left over, right, is profit after tax. And then we do that over equity. That's return on equity. So cost of capital is one, is the required return of the investors. And then return means return on anything would be a performance metric.
Okay, thank you, Steve. And we've had another question through about Section B. So this is obviously a hot topic for students. I'm glad that we've got into that a bit. So this student is asking whether in Section B, could the examining team ask about two different concepts in the same MTQ?
I think so. As a distractor, sure, why not? If we're talking about a investment appraisal multitask question, they could say do IRR in one part of it, then they could say do NPV in the other part of it, then they could pop in a theoretical question, which metric best measures shareholder wealth. They could even throw in a little bit of a payback period question. So yes, multiple questions, multiple topics can be in there for sure. They will be in there, guys.
Okay. Yeah. We've had a question through which I'm going to ask it. I'm not quite sure if I understand what it's asking. If it doesn't make sense to you either, Steve, then perhaps this student could just resubmit the question quickly. But they're asking whether providing an internet connection counts as capital expenditure.
If we're talking about the difference between capital expenditure and revenue expenditure, that's actually an FA topic, right? That's a financial accounting topic. The way I would read that, the internet bill here in PwC at my house, that is a monthly cost, guys. That is a revenue expense. That is not something that we capitalize. That's not a long-term, that's not a cost that's consumed over many accounting periods. So I would call that an operating cost, not a capital expenditure.
Okay,
however,
thank you, Steve.
if you buy routers and all of the equipment, if you're a big company and you've invested in hardware, then that's investment. That's capital expense.
Okay. Okay, I think we have covered the questions that have come through, and we are just about at time. So I think we're going to draw the session to a close there. Thank you very much, Steve, again for another fantastic session. Reminders for those of you listening, Steve has referenced several really useful resources which are in the resources section of this webinar, so you don't need to go anywhere else to access them. You can just go into the resources section and various links are provided there for you, including a link to watch Steve's first webinar on demand, also the Essentials on One Page document that he mentioned in his last slide there, where he talked through what your next steps should be. And remember, you will be able to listen to this session on demand as well. Once it ends in a couple of moments' time, you'll be able to just use that same link to get back into it. We'll also send you an email reminder tomorrow, just with details of how to listen to it again in case you've missed that. So it just remains for me to thank you, Steve, for your time and all the preparation that you've put in. We really appreciate it. And thanks to everybody for taking the time to join us and for asking your questions. And the best of luck with your MA exam whenever you might be taking it. Thanks, everybody.
Bye, everybody.